Okay, let's unpack this. We're witnessing a pretty pivotal moment in the crypto world.
Hmm.
Bitwise, a formidable asset management firm, has just submitted a filing with the SEC
Yep.
to launch a spot Chainlink ETF. Now, this isn't just another fleeting headline, right?
Not at all.
It feels like a potentially transformative step for Chainlink, LINK, as it's often known.
Definitely positions it differently.
Yeah, positioning it more squarely in the, let's say, institutional gaze of Wall Street.
Right.
You're likely familiar, most of our listeners probably are, with the groundbreaking success of the Bitcoin and Ethereum spot ETFs earlier this year.
Huge success. Unprecedented, really.
Exactly. And this latest maneuver, well, it signals a significant and, frankly, growing appetite within traditional finance for digital assets beyond just the top two, beyond Bitcoin and Ethereum.
Yeah, it really offers a fascinating window into how the crypto market is, maturing. Well, when a respected firm like Bitwise, and they're a firm that's already successfully navigated the intricate regulatory pathways to launch other crypto ETFs.
They know the ropes.
They absolutely know the ropes. So when they shift their focus to Chainlink, it profoundly elevates LINK's standing.
Okay.
It suggests a clear recognition of Chainlink as, well, an institutional-grade asset.
Right, moving beyond that perception of it being just maybe a retail narrative coin.
Exactly, moving towards something with deeper, more fundamental financial utility and, potentially enduring value in the eyes of traditional finance.
So what does this bold push for a Chainlink ETF really signify for the asset itself, LINK, for the broader crypto landscape? And maybe most importantly for you, our listener, as someone keen to stay truly well-informed in this, rapidly evolving space?
It's the key question.
Today, we're embarking on a deep dive into Bitwise's ambitious filing. We'll meticulously explore the underlying reasons why Chainlink was chosen.
Yeah, the why Chainlink is crucial.
We'll dissect the potential impacts this could unleash, examine the inherent risks and challenges involved.
And there are definitely challenges.
Oh, yeah. And draw crucial lessons from the journeys of previous crypto ETFs like Bitcoin and Ethereum.
There's a lot to learn there.
Get ready for some surprising facts, maybe some fresh perspectives, and certainly some incisive analysis. Hopefully this will give you a shortcut to understanding this pivotal development and its pretty far-reaching implications.
Let's do it.
Okay, let's kick things off by delving into the initial news itself. Chainlink's Wall Street moment. This all starts with the bold filing by Bitwise.
Indeed. And the core of this story, really, is Bitwise's official submission to the U.S. Securities and Exchange Commission, the SEC.
Right.
For a spot Chainlink exchange-traded fund. And like you said, this is far from just a speculative announcement.
No, it's formal.
It's a formal, comprehensive regulatory proposal. It requires extensive due diligence, commitment, resources. It's a serious undertaking.
And its significance, it feels pretty immense, doesn't it?
It really does.
This filing represents the latest stride in this rapidly evolving landscape of single-token crypto funds. It aims to create a regulated, accessible, and importantly, familiar gateway for a specific digital asset.
Moving beyond just Bitcoin and ETH.
Exactly. Moving beyond the big two. And for large institutional investors, the ones operating under really strict compliance rules.
Yeah.
This regulated access, it isn't just an option for them, is it? It's often the only viable path.
That's often the case. It's the only way they can get exposure to these nascent asset classes while ticking all their compliance boxes.
Right.
And, this filing, it doesn't emerge in isolation. It's absolutely a direct consequence of the extraordinary success we saw with the spot Bitcoin ETFs.
Which were huge.
And the Ethereum ETFs, both launched this year. These products collectively drew in tens of billions of dollars in new capital.
Tens of billions.
They proved a powerful new model for regulated crypto investment. They didn't just open a door, they kind of blew open the floodgates for a different kind of capital.
Yeah, the kind that moves in large, sustained flows from traditional financial markets.
Precisely. The big money, the sticky money.
Which unmistakably points to a growing appetite. This decisive move by Bitwise, it clearly illustrates a rising institutional desire for altcoins.
For things beyond BTC and ETH.
Yeah, cryptocurrencies beyond just the dominant Bitcoin and Ethereum. It signals a broadening of perspective within TradFi.
It really does, suggesting they're now seriously evaluating the entire digital asset ecosystem.
Not just sticking to the safe bets.
Right. Not merely confining their interest to the two giants. This means a shift from crypto, meaning only Bitcoin, to crypto, as this diverse array of digital assets with all sorts of different utilities.
Absolutely. And in doing so, it undeniably elevates Chainlink's status.
Oh, for sure.
This filing significantly bolsters Chainlink's reputation, cementing its growing perception as, like you said, an institutional-grade asset.
Yeah, it moves it away from being seen primarily as, a project driven mainly by retail speculation or maybe a fleeting narrative.
Which happens a lot in crypto.
Happens all the time.
Yeah.
It moves it towards one recognized for its foundational utility and its long-term potential.
And when an institutional player like Bitwise, known for its, rigorous selection process.
They don't just pick anything.
Exactly. When they put their considerable weight behind an asset like LINK, it's a powerful statement, isn't it?
It's a massive statement about Link's perceived fundamental value and, frankly, its operational maturity. They wouldn't touch it otherwise.
Okay, so let's delve deeper into the why behind the filing from your expert perspective. What's the strategic calculus here for Bitwise? What makes this more than just, a firm taking an exploratory shot in the dark?
Right, that's the key question. And the truly profound implication here is that this isn't just a publicity play.
Okay.
An ETF filing is an incredibly rigorous, resource-intensive regulatory undertaking. It's expensive, it's time-consuming. So it fundamentally signifies that Bitwise has identified sufficient, sustained demand from their client base for Chainlink exposure.
They see the demand.
They see the demand. And, more critically, they believe Chainlink meets a certain quite demanding threshold.
What kind of threshold?
Things like market maturity, regulatory readiness, and, crucially, undeniable utility. Enough to warrant this immense effort and the associated, often intense SEC scrutiny that comes with it.
Right. They've clearly done extensive homework then on Link's market structure, its tech, its potential.
Oh, absolutely.
Yeah.
Deep due diligence is table stakes for this kind of filing.
And beyond their internal demand assessment, it sends a pretty powerful message to the entire market, doesn't it?
It absolutely does. It sends a strong market signal. A signal that a major, highly respected asset manager has conducted exhaustive due diligence on Chainlink.
Okay.
By publicly filing, they are, in essence, endorsing Chainlink, saying, we see this as a viable and valuable asset for our sophisticated clientele.
Right, that institutional stamp of approval.
Exactly. And that kind of stamp can significantly influence how other asset managers, financial advisors, even individual investors perceive and approach LINK.
It helps legitimize it.
Absolutely. It helps legitimize the asset in a way that perhaps pure crypto-native adoption sometimes struggles to achieve on its own within traditional circles.
And if this ambitious filing actually gets the green light, gets approval, what's the broader, maybe longer-term impact we should be watching for?
Okay, zooming out, the broader implications are immense. If approved, such an ETF would act as a crucial, seamless bridge, getting traditional finance with the, burgeoning crypto world.
A bridge. I like that.
Yeah, it would dramatically simplify the process for a vast, largely untapped pool of traditional capital. We're talking pension funds, endowments, wealth managers.
The big player.
The really big players, simplifying how they can flow capital into Chainlink. This bypasses many of the operational complexities, the custodial challenges, the regulatory ambiguities.
Things that usually scare them off direct ownership.
Precisely. Things that typically deter direct crypto ownership. It essentially makes Chainlink accessible within their existing familiar financial frameworks.
This really opens up a fascinating avenue for discussion, especially for you, our listener. An ETF like this represents a potentially simpler, more regulated, and like you said, profoundly more familiar way to gain exposure to a complex digital asset like Chainlink.
Right.
Imagine being able to access a cutting-edge crypto asset through your regular brokerage account just as easily as buying shares of Apple or Google.
It lowers the barrier significantly.
It really does. It's about democratizing access and potentially transforming how you, or even your seasoned financial advisor, might integrate crypto investments into a diversified portfolio. This shift, from niche to mainstream accessibility, it's potentially a game changer.
No doubt about it.
So that sets the stage for the what and why of the filing itself. But to truly appreciate its significance, we really need to understand the asset itself, don't we?
Absolutely.
So let's shift our focus to that core question. Why Chainlink? Unpacking the foundation of Web3 data. Why this asset, out of all the thousands of altcoins out there, is attracting Bitwise's attention?
Yeah, that's an excellent question, and it gets right to the heart of Chainlink's fundamental value proposition. Its core utility, really, lies in powering oracles.
Okay, for anyone in our audience who might be new to this term, can you quickly explain what an oracle is in the context of blockchain and why it's so vital.
Of course. So Chainlink's fundamental purpose is to provide decentralized oracle networks. Now, think of these oracles as highly secure, tamper-proof bridges. Bridges that allow smart contracts, those self-executing contracts on the blockchain, to interact with the outside world.
Because normally they can't.
Exactly. Smart contracts, by their very design, are isolated environments. They cannot directly access information from outside their native blockchain. This creates a critical data gap.
Ah, okay.
Chainlink fills this crucial gap. It provides the eyes and ears that enable smart contracts to react to events and information originating off-chain.
Got it.
Without reliable oracles, the vast majority of practical blockchain applications beyond maybe simple token transfers, they just couldn't function.
So without Chainlink or something like it, smart contracts are essentially operating blind, stuck in their own little world.
Precisely. They are isolated by design. Now, this isolation is actually a security feature, but it's also a significant limitation for real-world use cases.
Right.
Chainlink bridges this divide. It brings external data and even off-chain computation securely onto the blockchain. And the kind of data we're talking about, it can be incredibly diverse.
Like what? Give us some examples.
Well, everything from real-time asset prices, which are absolutely critical for decentralized finance or DeFi protocols.
We'll get into DeFi more, I'm sure.
Definitely. But also things like sports scores for betting applications, weather data for insurance contracts, flight information for logistics, even verifiable randomness for gaming and NFT mints.
Randomness, how does that work?
Yeah, verifiable randomness function, or VRF. It ensures fair and unpredictable outcomes in things like loot box drops in games, or randomly assigning traits to NFTs when they're minted. Chainlink provides a provably fair source of randomness.
Okay, that's cool. So the range of applications is huge because real-world interactions are just inherently diverse and dynamic.
Exactly. Anything a smart contract needs to know about the outside world, and an oracle needs to provide it securely.
And the sheer scale of what Chainlink secures, I mean, the numbers I've seen are genuinely staggering. We're talking about securing trillions in value. Is that right?
That's not hyperbole. It's a demonstrable fact. Chainlink currently secures trillions of dollars in on-chain transaction value across the entire blockchain ecosystem.
Trillions.
Trillions. This isn't some small-scale pilot project. It's fundamental mission-critical infrastructure. It underpins the decentralized web's daily operations.
Wow.
Honestly, if Chainlink were to somehow fail, the ripple effects across DeFi and other Web3 sectors, they would be catastrophic.
And you mentioned DeFi there again. Can you elaborate a bit more on why Chainlink is particularly critical for this whole decentralized finance movement? Maybe first, for our listeners, just quickly, what is DeFi and why does it need oracles so desperately?
Sure. So DeFi, decentralized finance, is essentially trying to build a new financial system on blockchain technology. The goal is to remove traditional intermediaries. Think banks, brokers, exchanges.
Cut out the middleman.
Cut out the middleman.
Yeah.
Imagine lending, borrowing, trading, insurance, all happening automatically, governed by code, by smart contracts, rather than institutions.
Okay.
Now, for these systems to work safely and accurately, they need accurate, real-time, and tamper-proof data from the outside world, especially price data.
Ah, okay. That makes sense.
Chainlink oracles are absolutely indispensable for this. For accurate asset pricing, think about lending protocols like Aave or Compound. They need to know the exact value of the collateral someone puts up.
Right, to avoid liquidation issues.
Exactly. Or for stablecoins to maintain their peg to the dollar. Or for derivatives platforms settling trades based on real-world prices. Without reliable price feeds, these systems become incredibly vulnerable.
Vulnerable how?
To manipulation, things like flash loan attacks, where someone artificially pumps or dumps a price feed, or they simply fail to function correctly, leading to massive financial instability and loss of funds. Chainlink provides that critical, unshakable foundation of external data integrity.
Got it. So indispensable for DeFi. Beyond DeFi, though, where else are we seeing Chainlink's impact shaping the future of Web3?
Well, beyond DeFi, Chainlink's role extends to other critical areas, like gaming, as we mentioned, helping create provably fair outcomes with VRF.
Right, the randomness.
Exactly. And perhaps most critically for the future, it's becoming a cornerstone for the burgeoning sector of tokenized assets, often referred to as real-world assets, or RWAs.
RWAs, we hear that acronym a lot lately.
You do, and for good reason. This is where physical or traditional assets, think real estate deeds, art, commodities, maybe even company shares, are represented digitally as tokens on a blockchain.
Okay, so Chainlink is becoming the infrastructure layer for tokenization. Can you unpack that a bit more? What exactly are these real-world assets on a blockchain? Why are they burgeoning, as you say? And why is Chainlink so critical for their success?
Sure. So real-world assets, RWAs, on a blockchain involve representing tangible things like a house or a bar of gold, or even intangible things like intellectual property rights as digital tokens.
Okay.
This allows for things like fractional ownership. You could own a tiny piece of a building. It increases liquidity, makes trading easier, and provides transparent, immutable record-keeping on the blockchain.
And why are they burgeoning now? What's the hype?
They're burgeoning because they represent this massive bridge between the traditional financial world, worth trillions and trillions, and the efficiency and transparency of blockchain technology. It opens up huge new investment opportunities and potentially streamlines really old, inefficient processes.
Makes sense. So where does Chainlink fit in?
Chainlink is uniquely positioned as a key infrastructure layer here because it provides the reliable data and verifiable computation needed to accurately represent these assets digitally.
How so?
Well, for example, it can feed in the current market value of a tokenized commodity, like oil or gold, directly from trusted off-chain sources. Or it could verify the legal status or occupancy of a piece of real estate off-chain. It ensures that the on-chain value, the token's value, accurately reflects its off-chain reality.
Right, without that link.
Without that trusted, secure, decentralized link to real-world information, tokenization at scale just isn't viable. The digital representation would be disconnected from its underlying value, making it worthless or easily manipulated.
Okay, that's a huge potential market. And back to DeFi quickly, you mentioned decentralized insurance earlier. Can you expand on Chainlink's role there? Seems like another area needing real-world data.
Absolutely. Its data feeds are vital there too. For the proper functioning of complex DeFi protocols, yes, but also for creating genuinely decentralized insurance products.
Like parametric insurance.
Exactly like parametric insurance. Imagine an insurance policy built on a smart contract that automatically pays out if a specific, verifiable event occurs.
Give me an example.
Okay, say a crop insurance policy that pays out automatically if rainfall in a specific region drops below a certain threshold during the growing season. Or flight delay insurance that pays out if your flight is verifiably delayed by over X hours.
Okay.
Without Chainlink oracles securely feeding verified real-time weather data or flight status data from trusted external sources, those smart contracts are completely blind. They're utterly unable to fulfill their purpose.
Right, they wouldn't know if the condition was met.
Precisely. Chainlink makes these trustless, automated real-world interactions possible and reliable.
Okay, so for our listeners, let's try and connect this back to the investment thesis. What's your expert analysis to picks and shovels strategy here? What's the fundamental takeaway from all this utility?
Yeah, I think a key insight emerges when you consider how institutional investors think, particularly those with a longer-term horizon. They often prioritize assets with fundamental, verifiable utility.
Not just hype.
Exactly. Over purely speculative narratives or fleeting hype. And Chainlink, as this core infrastructure, represents the quintessential picks and shovels play of the crypto gold rush.
Explain that analogy.
Well, during a gold rush, sure, some miners strike it rich, but many don't. The consistent winners are often those selling the picks, the shovels, the blue jeans, the essential tools everyone needs.
Right, like Levi Strauss you mentioned earlier.
Precisely. So instead of betting on individual DeFi projects or specific Web3 applications which might succeed or fail, investing in Chainlink is like investing in the essential tools and infrastructure that all these projects need to function and thrive.
So you're betting on the ecosystem's growth, not just one specific project.
Exactly. The real insight here is that while many chase the gold, the smart money often invests in the enduring infrastructure. Chainlink isn't just another coin, it's arguably becoming the indispensable data backbone for Web3. That kind of investment potentially future-proofs you against the rise and fall of individual crypto projects.
That's a powerful way to frame it, like investing in the companies, building the roads, providing the electricity, managing the water supply for a whole city.
Perfect analogy. Rather than just individual businesses that use those services, Chainlink provides the crucial data highways and sort of the power lines for the entire decentralized economy to operate and expand.
And its value grows with the adoption of the whole ecosystem then.
That's the thesis. Its value is tied to the health and growth of the entire ecosystem, not just isolated applications.
And does this infrastructure strategy impact the risk profile differently than, say, investing in a meme coin or even a niche DeFi project? Seems like it would.
It absolutely offers a distinct risk profile. Now, it's still an investment in the volatile crypto sector, let's be clear. But its value is intrinsically tied to the overall growth and adoption of the entire blockchain ecosystem. Not just the success or failure of a single application or even a handful. This diversification of utility across hundreds, maybe thousands of projects, it provides a degree of risk mitigation.
How so?
Well, it means that even if a few prominent DeFi projects stumble, or a particular blockchain loses favor, Chainlink's underlying utility for the broader Web3 economy likely remains robust, as long as Web3 itself continues to grow.
It's systemic importance.
That's the key phrase. Its systemic importance is a key factor for institutional consideration. They like things that are essential, that are hard to replace.
Okay, that makes a lot of sense. Now let's pivot to the potential impacts of a Chainlink ETF. What it means for you. If this ETF gets approved, what could we truly see happen in the market? What are the ripple effects?
Well, the first and probably most profound impact would be unlocking new institutional capital.
Right. We saw this play out dramatically with the Bitcoin and Ethereum ETFs.
Yeah.
Billions flowed in, far exceeding expectations. What would that look like for Chainlink?
A Chainlink ETF, if approved, could usher in a significant, sustained wave of fresh institutional capital into the LINK market.
From who?
Again, pension plans, sovereign wealth funds, hedge funds, corporate treasuries. These are funds that, for various reasons, regulatory mandates, internal investment policies, stringent compliance concerns.
Right, the hurdles we talked about.
Exactly. They simply cannot or will not directly hold volatile crypto tokens. An ETF provides that compliant, familiar wrapper they need.
It enables them.
It enables them. It allows them to gain exposure without the operational headaches or compliance nightmares. It's not just a matter of willingness sometimes, it's a matter of enablement.
So it's about providing these traditional financial institutions with a vehicle that fits their existing frameworks, their existing comfort zones.
Yes, precisely. It provides them with a regulated, compliant, and crucially, a familiar investment vehicle to gain exposure to Chainlink.
Okay.
This would allow them to further diversify their portfolios with a crypto asset that offers, unique utility and growth potential within the digital economy.
Without needing to become crypto experts themselves.
Exactly. Without venturing into the operational complexities of direct crypto custody, managing private keys, dealing with various exchanges, navigating different tax treatments for digital assets. It removes significant friction. For many fund managers, it makes it almost a no-brainer from a logistical and compliance standpoint if they want LINK exposure.
This would also serve as a major validation of the Oracle sector as a whole, wouldn't it? It's not just about Chainlink anymore at that point.
Absolutely. That's a great point. The approval of a Chainlink ETF would serve as an incredibly powerful validation of Oracle's as a crucial, indispensable sector within the broader blockchain industry.
How so?
It would signify that data infrastructure, essentially the plumbing and the nervous system of Web3, is being recognized by mainstream finance and regulators as having significant, verifiable financial value, not just abstract technological importance.
Right. It's being treated as a real asset class, or at least a component of one.
Exactly. This legitimization would be a massive boost for the entire Web3 infrastructure narrative.
And that validation could have a powerful ripple effect across the entire ecosystem, couldn't it? Beyond just Oracle's.
It definitely could. This validation could cascade. It could boost confidence not only in Chainlink, but maybe in other Oracle tokens and projects. And more broadly, in the entire DeFi ecosystem.
Okay.
It would lend significant credence to other picks and shovels infrastructure plays that underpin the crypto economy. It demonstrates that the market is beginning to recognize and reward foundational utility over, perhaps, fleeting narratives or purely speculative trends.
It signals a maturation, like you said earlier, a shift toward valuing the underlying technological enablers.
Precisely.
Okay, let's consider the impact on different investor profiles. How would this fundamentally change things for our listeners, the retail investors, versus the large institutions?
Right, good distinction. For you, the retail investor, an ETF offers a remarkably simplified, regulated pathway to gain LINK exposure.
How simple?
Think about it. You wouldn't have to navigate the complexities of managing crypto wallets, setting them up, securing them.
Seed phrases.
Seed phrases, exactly. Dealing with decentralized exchanges, understanding gas fees, worrying about the security challenges of self-custody versus leaving coins on a centralized exchange.
Which carries its own risks.
Absolutely. An ETF makes accessing this asset as easy as buying shares in a traditional brokerage account through your existing Schwab or Fidelity account. That's a massive leap in accessibility, particularly for people new to crypto or those who just prefer traditional investment avenues.
Okay. And for the institutions, beyond just compliance, what's the core appeal for them?
For institutions, yeah, it's largely about compliance, but also comfort and operational efficiency. An ETF allows them to justify holding LEN within their highly regulated, compliance-bound portfolios. It meets the stringent requirements of their internal investment committees, their risk managers, various regulatory bodies.
Without needing specialized crypto teams.
Right. Without needing specialized crypto infrastructure or deep internal expertise in crypto custody, which is complex and expensive to build, it removes significant operational and regulatory friction. That makes it an attractive proposition for fund managers looking to diversify into digital assets without taking on a whole lot of additional operational risk.
Okay. Now, here's where I think it gets really impactful for the market structure itself. Market structure and liquidity dynamics. Can you explain the critical difference a spot ETF makes here compared to, say, a futures ETF?
Yes, this is a critical distinction, and it's where the rubber really meets the road in terms of market impact.
Okay.
Unlike futures ETFs, which track the price using futures contracts, financial derivatives, and don't necessarily have to hold the underlying asset itself.
Right, they just track the price.
Exactly. A spot Chainlink ETF, by law and structure, would demand that the ETF issuer physically buy actual LINK tokens.
They have to buy real LINK P.
They have to buy real LINK directly from the open market to back the shares they issue to investors. Every share of the ETFs represents a claim on actual LINK held by the fund. This means real-world on-chain demand for the asset itself.
So that's direct buying pressure, not just a financial derivative tracking it, but actual forced purchasing of the asset.
Precisely. Real demand hitting the order books. This constant, systematic buying pressure, especially if large institutional inflows materialize.
Which is the whole point.
Which is the whole point. It could provide significant and sustained price support for LINK.
How?
Well, it absorbs available supply from the market. This could potentially reduce volatility over time by creating a more stable demand base. And importantly, it could increase overall market liquidity. As larger volumes are traded through a regulated, easily accessible product, it makes the market deeper, more robust, and more efficient for everyone.
Can you give us a sense of the potential scale of this impact? I mean, if a major institution decided to allocate even a small percentage to a LINK ETF, what would that physically mean for the LINK market?
Right. This direct impact on the underlying asset's supply-demand dynamics is really the critical distinction from other financial products that don't involve physical acquisition.
Okay.
So, for instance, just spitballing here, imagine a large pension fund decides to allocate a conservative, say, 0.5%, 0.5% of its $20 billion portfolio to a LINK ETF.
Okay, 0.5% of $20 billion.
That single allocation alone translates directly to a massive $100 million demand for physical LINK tokens.
Wow.
$100 million worth of LINK that must be acquired from the market by the ETF issuer to back the shares that pension fund bought. These are not paper assets. These are actual tokens being bought and likely held, taken off the market.
Multiply that.
Multiply that across several such institutions, maybe even dozens.
Yeah.
It creates substantial and sustained buying pressure that's difficult to ignore and fundamentally alters the market's dynamics. It's basic supply and demand.
Okay, that's pretty compelling. So connecting this back to you, our listener, what does this all mean for you? Would you personally opt for a Chainlink ETF to gain exposure, or maybe for its simplicity and regulation? Or do you prefer the direct ownership, the self-custody, the control of your crypto assets?
It's a fascinating question, isn't it? About convenience versus maybe the core ethos of direct digital asset sovereignty.
It's a personal choice with valid arguments on both sides.
Definitely something to think about.
Right.
But let's not get ahead of ourselves. Let's explore the other side of the coin. Risks, challenges, and open questions. Because this isn't a guaranteed slam dunk, right? There are significant hurdles to overcome.
Absolutely not guaranteed. That's a crucial point to hammer home. The most significant hurdle, without any doubt, is that SEC approval is not guaranteed.
Right. The SEC, they've historically been notoriously cautious with crypto, haven't they? And while, yes, they've approved Bitcoin and Ethereum spot ETFs, there's really no guarantee this approval streak will just automatically extend to altcoins like Chainlink.
None whatsoever. What are the specific regulatory hangups or concerns the SEC might have with an asset like Chainlink?
Well, they have indeed been quite conservative historically.
Yeah.
And you're right. Just because BTC and ETH got through doesn't mean LINK automatically does. Each new asset presents its own unique set of regulatory challenges and concerns for the Commission.
Like what specifically?
Regulators may scrutinize single-token altcoin ETFs much more intensely, particularly concerning things like potential market manipulation.
Why? Because the markets are smaller?
Potentially, yes. Markets that might be perceived as smaller, less liquid, or perhaps having less robust surveillance mechanisms than Bitcoin's market, for example. And then there's the lingering critical legal question.
The big gun.
The really big one.
Uh-huh.
Whether Chainlink, or any specific altcoin for that matter, is ultimately classified by the SEC as a commodity, like Bitcoin, or as a security.
And that classification matters hugely.
Hugely. It has profound implications for how it can be regulated, how it can be traded, how it can be offered to investors. If the SEC deems an asset a security, it falls under much stricter regulations, the same ones designed for traditional stocks and bonds.
Which raises the question, what specific criteria does the SEC actually apply when they evaluate these altcoin ETFs? And how might Chainlink's unique utility as an Oracle network, its infrastructure role, factor into their decision-making? Does that maybe differentiate it from other altcoins that might look more like speculative investments?
That's a critical point. And honestly, the SEC's criteria aren't always crystal clear, especially for altcoins.
Yeah.
But generally, they look at several key factors.
Okay.
Firstly, the size and liquidity of the underlying market. They want to be convinced it's a deep, robust market that isn't easily manipulated by a few large players.
Makes sense.
Secondly, they look for surveillance sharing agreements with regulated markets, like the CME for Bitcoin futures, to help detect and prevent manipulation. Finding equivalent regulated markets for many altcoins can be a challenge. And thirdly, and this is perhaps the most controversial point for altcoins, whether the asset is sufficiently decentralized.
Why does decentralization matter to the SEC?
Because under U.S. law, specifically the Howey test, a key factor in determining if something is an investment contract, and therefore a security, is whether profits are derived primarily from the efforts of a central promoter or third party. If an asset is sufficiently decentralized, the argument goes, there's no central entity whose efforts investors are relying on.
Ah, okay. So how might Chainlink fare there?
Well, Chainlink's proponents would argue its functional utility as an Oracle network, its very broad adoption across many blockchains, and its decentralized network of independent node operators could indeed be a differentiating factor.
Arguing it's more of a utility or commodity.
Exactly, arguing for its classification as a utility or commodity rather than a security controlled by a central team. However, the SEC has been very hesitant to explicitly classify most altcoins, maintaining this cautious case-by-case stance. This ambiguity remains a significant challenge for any altcoin ETF applicant.
Okay, so regulatory approval is the biggest hurdle. What other risks are there? You mentioned concentration risk. What does that mean for an ETF solely focused on Chainlink?
Right, so a single token ETF, just by its very nature, concentrates all the investment into one specific asset, in this case, LINK.
All eggs in one basket?
Pretty much. And this can significantly amplify volatility.
Right.
What that means for investors is that substantial price swings in LNK, whether they're upwards or downwards, will be directly and often dramatically reflected in the ETF's performance.
Right. More potential upside, but also more potential downside.
Exactly. It potentially leads to a higher risk profile for investors compared to, say, a more diversified fund that spreads risk across multiple different crypto assets or even traditional assets.
And any specific issues with the underlying Chainlink network itself, a bug, a hack, a governance issue, those could be magnified in the ETF's performance too, right?
Precisely. Any specific vulnerabilities or challenges faced directly by the Chainlink network, whether it's a technical bug in the code, maybe unforeseen economic model changes that affect tokenomics, perhaps intense competitive threats from other Oracle solutions emerging.
Competition is always there.
Always. Or even internal governance disputes within the Chainlink community. Any of those could have an outsized and direct impact on the performance of the ETF. Why? Because there's no other asset within that fund to buffer those impacts. This concentrated exposure means investors really need to have strong conviction in Chainlink's long-term viability and its resilience.
Okay. Then there's also something some people might call narrative fatigue and niche perception. I mean, will traditional investors, the big institutions, truly embrace an Oracle-focused ETF? Is the infrastructure layer story compelling enough for broad adoption?
That's a very valid concern, and frankly, it's a key question for Bitwise marketing and education efforts if this gets approved. The question is, will traditional investors, particularly those maybe less familiar with the intricate mechanics and the critical, yet often unseen, role of Web3 infrastructure. Will they fully embrace an Oracle-focused ETF?
Or will they just stick to Bitcoin and maybe Ethereum?
Potentially. Is the infrastructure layer narrative, while fundamentally strong to those of us in this space, compelling enough for broad institutional adoption? Or will it be perceived as too niche, too technical, compared to the more straightforward digital gold narrative of Bitcoin or the smart contract platform or digital oil story of Ethereum?
So a successful launch would likely require a pretty significant educational push from Bitwise and others.
It definitely will. You have to wonder. A successful launch and widespread adoption would undoubtedly require a significant, sustained market education effort.
Explaining what oracles are.
Explaining what oracles are, why they're critical. This effort would need to help traditional investors clearly understand that foundational role Chainlink plays, how it enables the broader crypto ecosystem, how it underpins trillions in value, and how its growth is directly tied to the overall growth of Web3, making it not just a speculative bet, but a bet on the ecosystem itself. They need to see why the plumbing is essential and valuable.
So what does this all mean then? Is Chainlink the most underrated infrastructure play in crypto right now, with the real potential to break through into the mainstream institutional world? Or is it, despite its critical role, still maybe too niche, too in the weeds for broad appeal? It's a fascinating dichotomy, isn't it?
It really is. And it's a crying that Bitwise is clearly betting big on finding a positive answer to.
A multi-million-dollar bet, at least, in filing fees and effort. Okay, let's shift our gaze now to history and precedent. Precedent and parallel, learning from past crypto ETF journeys. This isn't the first time traditional finance has tried to integrate crypto, and there are definitely crucial lessons to be learned from what's happened before.
Indeed. The journey of other crypto products, especially the recent ETFs, provides invaluable context here. Let's start with the obvious one. Bitcoin spot ETFs 2024, the trailblazer.
Right, and we saw truly massive inflows there, didn't we? Far exceeding even the most optimistic initial expectations.
Unprecedented is the word. The launch of the Bitcoin spot ETFs earlier this year unleashed an astounding wave. I mean, over $50 billion in net new capital inflows within just the first few months.
50 billion.
50 billion. It provided absolutely unprecedented legitimacy for BTC as an asset class within traditional finance. This wasn't just some niche product launch. It fundamentally moved Bitcoin from being a speculative curiosity on the fringes to a much more accepted, accessible, and integrated part of serious institutional portfolios. It was truly a pivotal moment that reset market expectations for crypto adoption.
And it fundamentally transformed how many institutions viewed Bitcoin, didn't it?
It absolutely did. This move fundamentally changed how many institutions viewed Bitcoin, moving it from the fringes of alternative investments to a more accepted and, crucially, a more easily integrated part of the broader investment landscape. Before the ETFs, Bitcoin was often considered too risky operationally, too complex legally. The ETF wrapper provided the necessary comfort and regulatory clarity they needed.
So if we connect this to the bigger picture, the resounding success of the Bitcoin ETFs, it essentially established a critical regulatory and operational blueprint, right?
Exactly, a blueprint.
This blueprint, covering everything from finding acceptable custodial solutions to setting up market surveillance agreements the SEC would accept, this is precisely what Bitwise and likely other aspiring asset managers are now attempting to replicate for altcoins like Chainlink. They're hoping to leverage that established pathway to gain SEC approval more easily.
That's the key. The path has been paved, at least partially. Then following Bitcoin, we had the Ethereum spot ETFs, expanding the model.
Which was also huge. It showed that it wasn't just a Bitcoin-specific phenomenon, that other major cryptocurrencies could potentially follow suit.
Exactly right. The subsequent, though admittedly more recent and perhaps less impactful in terms of immediate flows, approval of Ethereum spot ETFs further expanded this model significantly. It proved that major altcoins, beyond just the king of crypto, could also attract regulated investment products.
Right.
This was a crucial step. It demonstrated broader regulatory comfort and adaptability from the SEC, beyond just Bitcoin itself. It signaled that the SEC's framework could potentially be applied to a wider array of digital assets.
And it showed maybe a willingness from the regulators to consider other digital assets as long as they met certain criteria.
Yes, it signaled a clear, albeit slow, regulatory evolution. It showed a willingness from regulators to consider other digital assets, provided they met certain stringent criteria. Things like market size, liquidity, and particularly, as we discussed, demonstrable decentralization to mitigate those market manipulation concerns.
And for Ethereum?
For Ethereum, its established ecosystem, its significant market capitalization, and its perceived decentralization, though that's sometimes debated, were likely key factors in its eventual approval.
Okay. Now, what's fascinating here, and maybe gives Bitwise some confidence, is that demand for regulated Chainlink exposure already exists, doesn't it? Even before this ETF filing. We can look at the Grayscale Chainlink Trust, LINKG.
That's an excellent point, and it really highlights that there is pre-existing institutional and accredited investor interest. The Grayscale Chainlink Trust, ticker LENKG, has been providing a way for investors, particularly institutions comfortable with the Grayscale structure, to gain exposure to Chainlink for some time now.
Right, but it's a trust structure, which is different.
Exactly. It's a trust structure, not an ETF. And trusts, especially closed-end ones like Grayscale's products, before potential conversion, can often trade at significant premiums or, more recently, discounts to the underlying net asset value, NAV, of the asset they hold.
Which isn't ideal for investors.
Not ideal at all for efficient capital allocation or accurate price tracking.
So an ETF would represent a significant upgrade then, resolving those pricing inefficiencies.
Indeed. A spot ETF would represent a far more efficient, far more liquid, and potentially lower fee investment vehicle compared to that trust structure.
Why? What's the key difference?
The key difference lies in the creation and redemption mechanism inherent in an ETF structure.
Okay.
Authorized participants, or APs, typically large financial institutions, can continuously create new ETF shares by delivering the underlying asset, in this case LNKOSK, to the fund. Or they can redeem existing ETF shares by receiving LINK KUK back from the fund.
And that keeps the price in line.
Exactly. This arbitrage mechanism essentially keeps the ETF's market price tightly aligned with the net asset value of the LINK tokens it holds. It prevents those significant persistent premiums or discounts often seen in closed-end trusts like Grayscale's historically were. It's a fundamental structural difference that translates into more efficient and fair pricing for all investors.
So it effectively scales up the existing demand for Chainlink exposure, but in a much more accessible and direct format.
Precisely. Benefiting a potentially much wider range of investors than the Grayscale Trust could reach.
Okay. Finally, while it's not an ETF, the example of MicroStrategy with Bitcoin. A corporate blueprint seems like another powerful parallel. It shows how traditional entities interacting with crypto can change the game.
It's a very relevant case study, absolutely.
Oh.
It illustrates the sheer power of institutional adoption and signaling, even if it's not through an ETF product.
What did MicroStrategy do?
Well, MicroStrategy, a publicly traded software company, adopted this incredibly aggressive corporate strategy of acquiring significant amounts of Bitcoin and holding it directly on its balance sheet as a primary treasury reserve asset.
Right, they bought billions worth.
Billions. And this demonstrated how a major corporate action, widely publicized, could dramatically transform market perception of Bitcoin. It attracted entirely new types of investors and capital flows as other corporations started to seriously consider similar strategies. It helped legitimize Bitcoin as a viable treasury asset for corporations, not just an individual investment.
So the takeaway is that any significant interaction between traditional entities and crypto, whether it's direct buying or regulated products, can fundamentally change the narrative and attract new capital.
Precisely. This shows how traditional entities interacting with crypto, whether via direct holdings like MicroStrategy or through regulated products like an ETF, can fundamentally alter the narrative, the perception, and the broad appeal of a digital asset. It legitimizes the asset in a way that pure crypto-native adoption sometimes struggles to achieve on its own within those traditional financial circles. It makes it understandable, relatable, and accessible to a much wider audience.
Okay, got it. This sets the stage perfectly. Let's dive into some numbers and trends now in our data deep dive. Visualizing Chainlink's growth and ETF potential, we're going to look at some key metrics that really illustrate Chainlink's journey so far and maybe help us anticipate the potential impact of an ETF. Let's start with the basics. LINK price history, past, present, and future potential. Where has it been? Where is it now?
Right. Looking back, it's definitely important to recall that LNK reached its all-time high, its AT, of approximately $52.
$52?
Yeah, back in May 2021. That was right during the peak of the last significant crypto bull run. That period, you'll remember, was characterized by immense retail speculation, unprecedented liquidity injections from central banks, and just a massive surge of interest across the entire crypto market. So $52 gives us that historical marker of its previous market potential under, let's say, peak conditions.
And currently, as we record this, it's sitting quite a bit lower than that peak.
Indeed. Its current price, as per our source context, sits around $15.
$15, so a significant drop from the high.
Yeah, which represents a significant pullback from that all-time high. Now, that reflects the broader crypto bear market we saw through 2022 and into 2023, but it still represents a substantial market capitalization for an altcoin, placing it firmly in the top 20 or so cryptocurrencies. The market now is arguably more mature, maybe less driven by pure retail speculation, and perhaps more focused on utility and the potential for institutional interest, like this ETF filing represents.
Okay, so what's truly fascinating here, then, is to consider whether a successful ETF launch with that associated sustained institutional buying pressure we discussed could realistically push LinkHack back towards, or maybe even beyond, its previous eighth territory of $52.
That's the million-dollar question, isn't it?
Or maybe the billion-dollar question. This isn't just about retail hype anymore, is it? It's a question of whether this new, potentially deep pool of institutional capital can fundamentally re-rate the asset based on its proven utility and infrastructure role.
Absolutely. The dynamics are different. The sustained large-scale demand from a spot ETF could fundamentally shift the supply-demand equation in a way that sporadic retail buying alone often cannot. It represents persistent programmatic demand that systematically absorbs supply over time. That could potentially lead to a more stable price floor and, yes, potentially drive significant price appreciation if the inflows are substantial.
Okay, price is one thing, but let's look under the hood at Chainlink Oracle growth metrics. Proof of utility. How has Chainlink's actual usage and adoption been growing over time? This seems crucial for demonstrating its fundamental value beyond just price speculation.
Absolutely crucial. If we were to visualize this data, you would see a really striking and continuous expansion in the number of Chainlink Oracle networks deployed, not just on Ethereum, but across various blockchains and applications over time.
Can you give some numbers?
For instance, looking at some recent data points, we've seen something like a 300% increase year over year in the number of active Chainlink Oracle networks. They're now serving over 15 distinct blockchains, including major players like Ethereum, Avalanche, Polygon, Arbitrum, Optimism, Base. The list goes on.
So multi-chain adoption is strong.
Very strong. This metric clearly shows increasing adoption across the entire blockchain ecosystem. It indicates growing trust and reliance on its services as kind of the go-to default solution for external data needs.
And the value it secures, you mentioned trillions earlier. That's a metric that speaks volumes about its indispensability, right?
Crucially, yes. We can track the exponential increase in the total transaction value secured, or TVS, by Chainlink's Oracle networks. And like you said, this isn't just a vanity metric. This directly reflects its importance and the immense financial trust placed in its infrastructure by the ecosystem.
From billions to trillions.
The aggregate value secured has soared from tens of billions just a couple of years ago to trillions of dollars more recently. This is driven by prominent integrations in major DeFi protocols. Think Alav, Compound, Synthetics, and countless NFT projects, gaming platforms, and other dApps relying on its feeds. This demonstrates its systemic importance. It's safeguarding vast amounts of digital wealth.
Okay. And what about partnerships? That's always a key indicator, isn't it, of a project's widespread integration and maybe its long-term viability.
Definitely. We'd also examine the proliferation of partnerships Chainlink has forged. And it's not just with DeFi protocols. They have high-profile partnerships with large enterprises in traditional finance. The SWIFT collaboration is a big one.
Right, the global banking network.
Exactly. Partnerships with cloud providers like Google Cloud, telcos, data providers, and a vast array of other Web3 projects, from gaming studios to supply chain management platforms.
So broad reach.
Very broad reach. These partnerships are a tangible testament to its widespread adoption and its deep integration across the decentralized landscape and increasingly bridging into the traditional economy. They show that Chainlink isn't just a project with theoretical potential, it's actively becoming the standard, the foundational middleware connecting the old economy with the new decentralized one.
Okay, that's compelling fundamental growth. Now, let's try to do an ETF impact comparison. Learning from Bitcoin and Ethereum, what can those charts of inflows versus price action potentially tell us, and how might we cautiously apply that to Chainlink?
Right. We can directly compare charts showing the significant inflows into the Bitcoin and Ethereum spot ETFs post-launch against the corresponding price performance of BTC and ETH during those periods.
And what did those charts typically show?
Well, these charts often reveal a pretty clear correlation, although maybe not always immediate, between sustained inflows and positive price action. For Bitcoin, for example, post-ETF launch, we saw an initial price surge, maybe 15–20% within the first few weeks.
Yeah, I remember that.
Then there was a period of consolidation, maybe even a slight dip, as some early players took profits. But then, sustained growth kicked in as larger, slower institutional allocations ramped up over months, eventually propelling BTC to new all-time highs later in the year.
And Ethereum, was it similar?
Ethereum's pattern, being more recent, is still unfolding, but it has shown signs of a similar trajectory, though perhaps with a slightly longer lag time before significant price action really took hold post-approval. This might suggest that altcoins, even major ones like ETH, might require a bit more time or education for the institutional capital to fully flow in and impact the price.
Interesting. So what would that help us forecast for LINK? Are we expecting a similar pattern, maybe an initial pop, then consolidation, then sustained growth, or something different given its unique position as an infrastructure token?
Well, this comparison helps us model and understand potential patterns for Chainlink. For example, looking at BTC and ETH helps us ask, did prices immediately surge, or was it more sustained, gradual growth? What was the typical lag time between those initial inflows starting and noticeable price appreciation occurring?
Right.
Applying these observations to LINK can give us a sense of potential scenarios, though, of course, past performance is never a guarantee of future results.
Always the disclaimer.
Always. However, one key difference to consider. Given LINK's significantly smaller market capitalization compared to Bitcoin, and especially Ethereum,
Right, it's much smaller.
much smaller, a similar magnitude of capital inflow, say $1 billion, could potentially have an even more pronounced proportional impact on its price dynamics compared to the impact on BTC or ETH.
Okay, that makes sense. Less market depth to absorb the buys.
Exactly.
So based on that thought, let's consider some LINK ETF demand scenarios. Hypothetical inflows. Can we try and model, even roughly, what might happen if specific amounts of institutional capital were to flow into a hypothetical LINK ETF?
We can certainly begin modeling the potential impact by considering some hypothetical scenarios. These are just illustrative, of course.
Understood.
Let's assume, maybe conservatively, a $1 billion net inflow into a Chainlink ETF over, say, the first quarter post-approval.
Okay, $1 billion in 3 months.
Right. Now, given Chainlink's current circulating supply, which is roughly 587 million LINK tokens and a market cap of around $8.8 billion at its current price of $15, that $1 billion inflow represents over 11% of its entire current market capitalization.
That's significant.
Very significant. That inflow would necessitate the ETF issuer buying approximately 66 million LINK tokens directly from the open market.
Taking 66 million LINK off the market.
Essentially, yes. Now, based on historical price elasticity observed in similar market events for assets of this size, that kind of demand shock could realistically push LINK's price up by, let's say, 25% to 40% within that initial period, assuming no significant opposing sell pressure suddenly emerges.
Okay, 25–40% from $1 billion. What about a more optimistic scenario?
Well, if we consider a more optimistic, but maybe still plausible scenario of, say, $5 billion flowing in over the first year.
$5 billion?
That's over half its current market cap. That kind of sustained buying could potentially lead to 100% to 200% price appreciation, or possibly even more. It could potentially send LNK well past its previous all-time high, simply due to the sustained demand overwhelming the available supply on exchanges.
Wow. So this raises that crucial consideration again. How would such inflows, relative to LINK's current market cap and circulating supply, really affect its price dynamics, particularly with that physical buying requirement of a spot ETF?
That's precisely the critical factor, the core mechanic here. Every single dollar flowing into the spot ETF translates directly into a dollar of demand for the underlying asset, LINK. And for an asset with a smaller market cap like Chainlink, compared to giants like Bitcoin or Ethereum, a given inflow, say $100 million, will have a far more significant proportional impact on its price. The sustained demand from these large programmatic buys by the ETF issuer could systematically absorb available supply from sellers, leading to potentially considerable and maybe even rapid price appreciation, especially if supply is tight.
So it's not just theoretical. It's about the real market mechanics of how these spot ETFs operate and their direct physical influence on the asset's valuation.
Exactly. It's a powerful mechanism.
Okay. Finally, in this data section, let's try and visualize Chainlink's foundational role with a DeFi dependency map. Chainlink as the central nervous system. Can you paint a vivid picture of this for our listeners? How interconnected is everything with Chainlink?
Yeah, imagine looking at a complex, interconnected web, maybe like a subway map of a major city like London or New York.
Okay, got the visual.
Each major station, each hub on this map, represents a crucial decentralized finance protocol or a major Web3 application. So you've got stations labeled Aave, Compound, Synthetics, Lido, GMX, maybe popular NFT marketplaces like OpenSea or Blur, gaming platforms, other dApps.
All the big names.
All the big names, and many smaller ones too. Now imagine intricate lines, like the subway lines, connecting nearly every single one of these stations back to a central, critical hub.
And that central hub is Chainlink.
That central hub is Chainlink. This map would powerfully illustrate just how many crucial protocols are critically reliant on Chainlink's data feeds, its price feeds, its proof of reserve feeds, its randomness feeds for their core functionality.
Give an example on the map.
Okay, take Aave, a leading lending protocol, a major station on our map. It uses Chainlink price feeds for virtually all the cryptocurrencies it accepts, as collateral ETH, wrapped BTC, stablecoins, other altcoins. Without those reliable real-time Chainlink feeds,
Aave is in trouble.
Aave is essentially lending and borrowing in the dark. It becomes incredibly vulnerable to flash loan attacks manipulating collateral prices, or it might fail to liquidate under-collateralized positions accurately and on time. For protocols handling billions, this isn't just a nice-to-have, it's essential operational reality.
It underpins hundreds of billions of dollars across the ecosystem.
Exactly. This visualization dramatically demonstrates Chainlink's foundational role. It showcases it not just as one component among many, but as the essential central nervous system or the data backbone for a vast and rapidly growing ecosystem.
Right, underscoring its systemic importance.
Precisely, and that systemic importance is a key factor for institutional consideration when they're looking for long-term, non-speculative value in the crypto space. They want infrastructure.
Okay, that paints a really clear picture. So, wrapping this data section up and thinking about the future again, what does all this mean for you, the listener? Do you think this potential ETF, combined with this fundamental growth, will send LINK back to its impressive H of $50, maybe even beyond? Or is it just initial hype around the filing that will eventually fizzle out once the immediate buzz dies down, regardless of approval?
It's the big debate right now in the LINK community and beyond.
We'd genuinely love to hear your predictions on this, your thoughts. So please, drop us a comment below the video, let us know what you think.
Well, we've certainly taken a comprehensive deep dive today, haven't we? Into Bitwise's ambitious filing for a spot Chainlink ETF.
We covered a lot of ground.
We really did. We've meticulously unpacked why Chainlink seems so pivotal as an oracle network, discussed the massive potential impacts this ETF could have on both institutional and retail investors.
The accessibility factor is huge.
Definitely. And of course, we examined the significant hurdles, the risks, and the open questions that still remain before any potential SEC approval actually happens. Yeah, approval's still the biggest if.
Absolutely. So, zooming out one last time, thinking about the really big picture, this Chainlink ETF filing, it really raises an important question for the entire future of crypto, doesn't it?
What's that?
If this is successful, if Bitwise gets the green light for a LINK ETF, should other prominent altcoins with strong utility, strong ecosystems, and maybe projects like Solana or Polygon or Avalanche, should they expect to see their own single token ETF filings next?
The potential floodgates argument.
Exactly. And what would that cascade of single token altcoin ETFs truly signify for the broader crypto market's ultimate, maybe full-scale integration into traditional finance?
That's a profound thought. Would it mean crypto truly arrives on Wall Street, not just Bitcoin and Ether, but the whole diverse ecosystem? Or would it create new complexities and risks?
It's definitely something profound for you, our listener, to mull over as the industry continues to evolve and reshape itself, constantly pushing the boundaries of what's possible in finance.
Food for thought, for sure.
Absolutely. And if this deep dive gave you clarity, if it helped you wrap your head around Bitwise's bold push for a Chainlink ETF and what it all means,
Hopefully it did.
we truly encourage you, please like this video, subscribe to our channel if you haven't already, and definitely tap that notification bell so you don't miss our next deep dive.
Your engagement really does make a difference.
It absolutely does. It really helps support our channel. It significantly boosts our visibility in the algorithm, helps others find this content, and honestly, it just lets us keep creating quality, in-depth content and these deep dives into the biggest moves happening in crypto and Web3.
We appreciate every like, every subscribe, every comment.
We truly do appreciate your support, and we look forward to diving deeper with you again next time.